So welcome to the standard setting update. I'm Dima Andrienko, Deputy in the Office of the Chief Auditor. Pleasure to be here today, and we do hope that you find this presentation also helpful. That was the intent in assembling these materials. The Office of the Chief Auditor assists the board with developing new professional standards. And so this section covers some of the standards that you probably haven't read yet. And that's okay, because none of them are effective yet, but some of them will become effective pretty soon. So there's time to catch up. As I will give you my official disclaimer next, those of you who have your computers, iPads up, if you want, you can go to our webpage on the PCAOB website, go to the standards webpage, and if you want, follow along for the first maybe like 10-15 minutes as I will walk you through the pages on standard setting and the board agenda. It's not mandatory. You'll be perfectly fine with the handouts and the slides, but if you want to do that's fine too. So that's my official disclaimer, similar to other PCAOB staff who present here. The views are of my own, not those of the board members, board staff, and any other staff of the PCAOB. Okay. So this is our plan for the next 50 minutes or so. We'll spend most of our time on the second part of the content that you see on the slide. I'll give you an overview of two standards that have been recently adopted by the board, but not yet approved by the SEC. Adopted by the board means they've been approved by the board, but the second necessary step is for those standards to be approved by the SEC. Usually takes a few months. And then we'll spend a little bit more time on the new confirmation standard, and that standard has been adopted by the board and also approved by the SEC. So all of these projects, those three, I mean, they're different, but one thing they have in common, like board member Bodick mentioned, they are part of the board's effort to modernize the board's professional standards. So there are many more projects underway, and that would be the first part of our discussion on standard setting projects. And we're showing it to you because we would really like to hear from you on things that are still ongoing and not yet approved by the board. Our chair, Erica Williams, made remarks at the first Small Business Forum of this year in Chicago, and some of the statistics that she used was that there are more than 500 triennial inspected firms that audit or play a substantial role in the audits of 3,200 public company issuers. And there are almost 300 firms that audit approximately 3,300 SEC-registered broker and dealers. So it's important that the standards that are used by smaller firms are designed for smaller firms of all sizes. So there are good examples, just going back in history, of staff guidance and standards where views of smaller firms informed our rulemaking and development of staff guidance. If you think back to the early years of the audits of internal controls, I think this guidance, the guidance for ICFR audits of smaller companies is still in use, and it was developed by PCAOB staff working with a working group of smaller firms. That's a good document. And another example from years back, our standard on engagement quality reviews has this exemption from the cooling off period for engagement partners of firms of certain size, and it was added there also in response to comments received from smaller firms. There are other examples. The small firm space is always at the forefront of our thinking as new standards are being developed. And there are also examples in the materials, in the requirements we're discussing today where that was the case. So, I mean, the way I look at this, no firm is too small to submit a comment letter on our proposal, and no comment letter is too short to be considered. We read them all. We especially appreciate those that have practical examples data, references to research, but it could be an email to us. So please do speak up. Okay, our first commercial break features the number of 3:57. Please note it down. Okay, so now we're going to pretend that we're navigating through the PCAOB website. So you go to the PCAOB website, go to our standards page, and you click on, and so that's what you will see as part of that page. So for those of you who will, after this session or sometime in the future, would like to comment on our proposals, you click on the second box from the top, and that's standard setting, research, and rulemaking projects. So we're going to pretend that we do that. So this is a so this is a screenshot, and it's a simplified version of what you will see on that page. So the first category is recently issued proposals. The second one is recently completed standard setting projects, and that is material that we're going to cover today. So the rest of the items is basically the PCAOB's standard setting agenda. Short-term projects are those where PCAOB staff are actively working on the project, and the board action is expected in the next 12 months. So it's sort of the imminent ones. The midterm is where staff is working on a project, but a board action is not expected in the next 12 months, and then there is an ongoing research. So to tally it up, if you go there, we've got 2 research projects, 6 midterm projects, and 8 short-term projects. There are 4 recently completed projects, of which we're going to cover 3 today. And there are 6 recently issued proposals. We'll go to that page 2, virtually, like this. So the rulemaking projects, bottom of the list, those are the projects that are typically, although not always, led by our Office of the General Counsel, and that deal with various matters. They deal with interaction between the firms and the PCAOB. So going to our standard setting page, you literally can see sort of months and even years ahead. You can see what's coming in, see what's maybe of interest to you. We continue clicking on the links, and so if you went to our standard setting rulemaking proposals, you will see that there are 6. I mean, they're noted as recently issued, relatively speaking. So the ones at the bottom of the screen, those are the ones that are rulemaking proposals that are led by the Office of the General Counsel. Across the top, in the middle, you see technology-assisted analysis amendments proposal went out last year. Non-compliance laws and regulations also went out last year. On those, comment period has already closed. The staff are analyzing comments received. Now, the one at the top left, firm and engagement metrics, has the comment period is still open. It closes in 3 days. So today, tomorrow, day after tomorrow, you have time to look at the document, and if you're interested, submit your comments. And I will walk you through some of the highlights of that proposal. So the project stems from the recommendations of Treasury's Advisory Committee on Auditing Profession and goes back to like late 2000s. In 2015, the board issued a concept release on audit quality indicators, analyzed comments, reviewed voluntary disclosures by some of the firms, and then considered recommendations from the board's investor advisory group. So this work resulted in a proposal that went out a few months ago, under which some, not all, registered public accounting firms would publicly report certain information about their business on a new Form F on two forms. One is new, one is not. And that would be at the firm level and at the engagement level, those metrics. And I'll touch on those metrics. I'll give you examples. So the reason, as I said, it goes back to the recommendations the PCAOB received. The reason is to provide additional information about certain audit firms, namely those that audit larger public companies. And that information will be available to any interested stakeholders, including investors, audit committee members. And as I'm thinking about that to auditors, anybody, really, you can learn about other firms by, if this is a proposal, right? So if it's adopted the way it was proposed, you will see information about other firms. So what are the examples of those proposed metrics? Could be relative workload of partners and staff in hours, use of auditor specialists and shared service centers on engagements, industry experience of partners, overall staff experience, retention, tenure. There are 11 types of metrics overall. So not all firms would be required to report those metrics, and not on every audit. Firm level reporting will be required for every firm that during the reporting period audits at least one accelerated filer or large accelerated filer. The determination of whether the firm is required to report at the firm level would be made every 12 months as of September 30th. And that would be firm level reporting will be done on the new form FM. Engagement level reporting would be required of every audit of either large accelerated filer or accelerated filer. So those are the highlights that I wanted to give you on this proposal. If you're interested, take a look at the document. As with all of our proposals, it could be a large document, but the actual rule text is fairly brief. That would be a few pages, not a few dozen pages. But then, sure, you can take a look at it first. If you have any questions, you can look in the actual release document, and you'll probably find answers to your questions and the reasons for why a particular provision has been proposed. Well, this completes the first part of our discussion of our rulemaking process and the standard setting agenda. Do you have any questions? All right. So on to the second part, and that's where we're going to spend most of our time. So we're going to focus on 3 of our recently completed projects. Like I said, they're all different, but they're all part of the modernization of the board standards. The top 2 have not been approved by the SEC yet, but the confirmations, standard and confirmations has been. And they're all included under the recently completed projects on the standards page, so you can go there, and that's where you can find them and click on each project and see the materials. Okay, we're going to start with AS 1000. So this project got its name from a group of standards, we call them the 1000 series, and that are being combined under this proposal into one new standard, AS 1000. But as you can see on the screen, there are other things that are included, other matters that are considered in this rulemaking. And what all of these matters have in common, they deal with some of the fundamental responsibility of the auditor, and in particular, some of them of the engagement partner. Although, spoiler alert, most of these matters, most of the updates, they will not change the existing requirements. We still think it's important to discuss them with you, to give you sort of an overview so you can better orient yourself with this new and simplified framework of standards. So we'll take a look at them one by one. So we'll start with the second bullet from the top, and that's AS 1000. Like I said, it's a new standard. It combines several sets of requirements into one. So in the interim standards issued by the AACPA, and I mention them because those are the ones that the PCAOB adopted in 2003 as its interim standards and has been going through them sort of throughout the years, updating them and issuing PCAOB sort of own standards, replacing the old ones. So the 1000 series are sort of the vestiges of that set of standards that were adopted in 2003. And so they address things like responsibilities and functions of the auditor, independence, training and proficiency, due professional care. So now they're going to be in one standard, AS1000. But it was not just an exercise in sort of kind of reshuffling the requirements. The newly issued PCAOB standards, they're all keyed off of certain rules that are also issued by the PCAOB, and they use certain terms like must and should, and there are defined terms. There are also certain concepts that are issued in the standards of the PCAOB, included in the standards of the PCAOB, that are sort of the same throughout the standards. So the PCAOB issued standards, we take great care making sure that they're consistent. Well, the old ones, they really did not dovetail into the sort of new standards, and that's what this project did for these standards. I'll give you examples. So now they're framework neutral, so they refer to the financial reporting framework, not just GAAP. It could be, you know, the international financial reporting standards too. They're referring to PCAOB independence rules, referring to the sufficient and appropriate audit evidence, not just competence and sufficiency of evidence. So that's sort of the general theme of updating the language. But the standard does not create any new principles. Moving on to the next bullet, present fairly, very similarly, sort of thematically. The auditors, so now we're in the amendments to other PCAOB standards. And I'm talking about the first bullet, clarify the auditor's responsibility to evaluate whether the financial statements are presented fairly. So these requirements are included in a separate standard now, 2815. There's some duplication with our main standard on evaluating audit results, 2810. So now the 2815 has been folded into 2810. So if, you know, a few months from now, if you look for that standard, you will not find it, but look in 2810. And like with many of our releases, there will be a sort of I'm saying fake red line, but it would be a document where you can see, kind of like what FASB does, remove provisions that are going to be struck out, and the new ones will be underlined so you can see what changed in our standards. It's not there yet. Okay, the next bullet, clarify the engagement partner's responsibilities. So this one focuses on the engagement partner. I'll give you examples of certain things that had been emphasized. None of them will surprise you that the engagement partner has to do that. The engagement partner should review the documentation of significant findings and issues, and that's something that is required in our documentation standard. Review the documentation that is required to be submitted to the engagement quality reviewer. So the engagement partner reviews something before the engagement quality reviewer looks at it. And the engagement partner's review and evaluation of the work should be done prior to the report release date. So those are the things that are being emphasized by this project. Now, the last bullet is a change in the existing requirements, and that's something that Board Member Bodig alluded to in his remarks. So you can see the acceleration of the documentation completion date from 45 days to 14 days. Okay. Under existing standards, and that's paragraph 15 in our standard and documentation, I'll read, complete and final set of audit documentation should be assembled for retention as of date not more than 45 days from the report release date, and this date is known as the documentation completion date. Okay. So just stepping back to understand the reason for changing this, the reason any time limit was introduced, and it was 20 years ago when the board adopted this in 2004, is because documentation that is completed contemporaneously with the work done is of better quality than documentation that's prepared much, much later. And so any term could have been, chosen, but at the time, 45 days, 6.5 weeks was the term that appeared reasonable, given that a lot of the documentation was still on paper. And this is not just smaller engagements, but also engagements that are multi-location, multinational engagements where papers would have to be, certain papers would have to be physically shipped, FedEx, whatever, to the office that issues the auditor's report. So 45 days was a reasonable time frame that was given at the time. Fast forward 20 years now, most of the audit documentation is electronic. And another way to look at this time period, it's not anyone in this audience, but bad actors, they will use this time, as much time as you're given, 45 days, to alter inappropriately the documentation. And then, as our colleagues in the Office of Enforcement and Investigation will tell you, there time and again there are cases with improper alteration of documentation. And so what was proposed, again, it was proposed first, that acceleration from 45 days to 14 days. It was considered, comment letters were reviewed, and ultimately the board approved this new 14-day period. So it's basically, it's meant to balance, on the one hand, investor protection, on the other hand, given firms time, so 2 weeks to finalize the documentation. So that's sort of the thought process and the reason behind this change. But you will see, we're going to move on to the next slide, and you will see that smaller firms are given extra time, an extra year, to comply with this requirement. So stepping back, AS 1000 project, the AS 1000 standard, other amendments to other standards that deal with engagement, partner responsibilities, et cetera, that whole package is effective for audits of financial statements, and that's the first bullet, beginning on or after December 15th, 2024, except for this documentation completion date provision. So then it kind of splits for larger firms, smaller firms. The firms that during this calendar year, the one that's ending at the end of this year, issue a report with respect to more than 100 issuers. This provision applies for, again, fiscal years beginning on or after 12/15/24, but all other firms are given an extra year. And if you look at the date, so it's for audits of financial statements for fiscal years beginning on or after 12/15/25. So there's basically the financial reporting year of 26, and therefore the documentation, the accelerated documentation would be in early 2027, so basically 3 years from now. All right. Any questions as I'm going through that? There's a question.
One question from the chat. Are there any themes of industry comments expressing concerns about shortening the document completion date from 45 to 14 days?
Yes, there are comments that supported the provision. There are commenters that supported the provision. There are commenters who opposed the provision. It's typically the case that there are views on both sides on all of our rulemaking proposals, okay? If you submit a comment, like I encouraged you earlier today, and Georgia Board Member Bodig also did, if you submit a comment, it's not a guarantee that that provision will be copied and pasted in the final version. So yes, there are commenters who oppose that, and that's the job of the PCAOB as an organization to analyze comments and consider them and make a decision. That's why I emphasize that it was proposed and the comments were considered. Yes, there are commenters who opposed it, and after the consideration of all the comments, the decision was made to go forward with a 14-day period, and that was get adopted by the board, submitted to the SEC for approvals, and see what happens. Any other comment, Kevin? Good to go. All right. Okay. QC 1000. Like I said, of the three projects that we're looking at today, AS1000, QC1000, and confirmation standard, they're all very different. Like this one gives you a very high-level overview of the QC project, and it doesn't even get close to scratching the surface. It's big. It's very important. We still think it's important to mention it today, even though like we're going to be sort of going really high level, because it affects every single firm, even firms, as you will see, who are registered with the PCAOB but do not perform audits. Every step was informed by extensive research and outreach. I'm going to skip. Oh, sorry. I'll give you examples of research and outreach. So PCAOB inspections and enforcement activities, discussions with the PCAOB advisory groups. A concept release was issued in 2019, and a proposal was issued for public comment in 2022. So this QC1000 replaces the current QC standard that was adopted by the PCAOB in 2003, but it was really developed by the AACPA in 1997. So again, fast forward 27 years, many things have changed. The profession is no longer self-regulated. There's the PCAOB inspection program. Firms have to respond to QC findings. We talked about remediation today, et cetera. So that's new. That was not in place when the current QC standards were issued. Firms use technology a whole lot more for their QC system in the audits. That's a big change. And then firms change their management and organizational structures, I don't want to say in response to the existence of the PCAOB, but not smaller firms, larger firms. Sometimes they're more centralized. There is global audit methodology that's developed centrally and pushed down to the affiliates. So many changes. Now, our current QC standards that are developed, like I said, a long time ago, and they've got high-level principles, but they do not directly address these developments. And so that's what the new one does. It is more specific. It sets quality objectives, and it also includes some specified quality responses. Now, as you know, before the PCAOB adopted the new standard, the IAASB and ASB issued their own. So I always get tangled with the acronyms, but ISQM1 and SQMS1. I challenge you to say it fast. So the good news is that the firms can leverage those who have adopted those standards. And the vast majority of firms that are registered with us, they also perform audits of non-public companies. And so they've already invested time and effort in developing new QC systems that are compliant with these requirements. So the good news is that firms can leverage their investment of time and effort. The IAASB and ASB standards, they inform the board's thinking, but the QC 1000 also has certain alternative and incremental provisions, and it's clear why, because we operate in a public company space, and there are things like independence, the SEC rules and PCAOB rules and independence, and views of investors that the board have to consider. And so examples of differences would be firm governance of the largest firms, more specific requirements for monitoring and remediation, ethics and independence component that is aligned with the SEC and PCAOB requirements. There are some examples. So like I said, QC 1000 applies even to those firms who are simply registered with us. So according to the QC release, and that's where I got this information from, of the 1,600 firms registered with the PCAOB at the time, about half do not perform audits. So all firms are required to implement all firms are required to design a QC systems. Even if you do not perform audits, you design your QC system. But firms that perform audits, they're required to implement and operate the QC system. So it's, like I said, it's a comprehensive and extensive and comprehensive standards. Please go to our website and you can go through the release and get more information about this standard. So we're about, I think, halfway through our presentation. So I'm going to talk about the evaluation, scalability, and effective date. So firms that implement and operate QC system will be required to annually evaluate the QC system and report the results in a new non-public Form QC. Evaluation should be done annually as of September 30th, reported to the PCAOB no later than November 30th. Effective date, if approved by the SEC, QC 1000 and related amendments will take effect on December 15th, 2025. Initial evaluation will be performed as of September 30th, 2026, and initial reporting to the PCAOB on the new Form QC, which is non-public. So unlike with the proposal on firm and engagement metrics, that's public reporting, this is non-public reporting that everyone will see. This goes to the PCAOB. So the reporting on a new Form QC will be done, should be done by November 30th, 2026. It's designed to be scalable, the last thing I will say, and that's, there's some incremental requirements for larger firms, like they would have to establish an external oversight function. But firms that issue 5 or fewer engagement reports may include audits not performed under PCAOB standards in some of their monitoring activities. So if there is just one audit, the PCAOB audit, and so it's the partner, you don't want to pick on that partner like every year. It may discourage some of the people to even be an engagement partner or not engagement. So you can include in your monitoring system other audit, non-PCAOB audit in that. And so that audit will be sort of in rotation, but not necessarily picked every year for internal firm review. And depending on the nature and circumstances of the firm, a single individual may be assigned more than one of the QC system oversight roles required under the standard. So it's like, it should be one person should have responsibility over a particular function, not 2, not 3, but just one, but one person can also have several functions. Okay, with that, here's a new CPU code. If you have any questions, let me know. If not, we're going to move on to our last item, which is a new standard on confirmations. Oh, I'm sorry. I see, but yeah. 571. Apologies. Okay. New confirmation standard, adopted by the board, approved by the SEC late last year, and becomes effective for fiscal years ending on or after June 15th, 2025. Said differently, it becomes effective for audits of fiscal years that are beginning in a few weeks. It replaces the existing standard on confirmations. One reason to change it was that it became outdated. It's one of those standards that are issued by the AACPA. This one was issued in 1992. So the emerging technology, Kevin?
You may have slip back to the
Yeah, thank you. So 1992, the emerging technology in 1992 was the fax machine, and most of the confirmations were on paper. Fast forward 32 years, the emerging technology is ChatGPT, and many confirmations are done electronically. Second development was the entrance of intermediaries on the stage. So in fact, some financial institutions in the United States, abroad, they would not even respond to a confirmation that is not done through an intermediary. And in the last 20 or so years, there are some high-profile fraud involving not confirmation. They had confirmations been performed, maybe frauds would have been discovered faster. Think about Parmalat, think about Wirecard. I realize I'm starting to speak quickly just because there was a lot to cover. I'm pulling behind a little bit. So these are the topics we're going to cover in this session. But before we do that, I just want to spend a few minutes to talk about confirmations as a procedure in general, so the reasons behind some of the requirements will become clear. I guess what sets confirmations apart from other audit procedures is the type of evidence that it provides. So generally, under PCAOB standards, information that originates from an external party independent of the auditor is more reliable than company-produced information, and information that is obtained directly by the auditor is more reliable than information obtained indirectly. Confirmations gives you evidence that has both of these attributes, okay, from external party and obtained directly by the auditor. Put simply, it provides high-quality audit evidence. And so let's connect this with points on the slide. Confirming parties, so for a confirmation to provide high-quality evidence, there should be this direct link between the auditor and the party that provides this information. And so the auditor should maintain control over the confirmation process. So that's why dealing with confirming parties is important. Negative confirmations, not every confirmation provides same level of audit evidence. Positive confirmation provides better evidence than negative confirmation. And finally, we'll take a look at cash and accounts receivable, very important accounts, and what kind of procedures could be performed there to obtain high quality evidence. Okay, confirming parties. So you can see the requirement in the new standard. So it's the same number, 2310, same standard, but this is referring to the new standard. So this requirement is more direct than in the existing standard. So the auditor is required to determine that the confirmation requests are properly addressed. So that's the basic principle, and the new standard does not tell you what procedures the auditor has to perform. There are some examples here, and there are two boxes. One deals with instances when the auditor does not involve an intermediary, and the other one when the intermediary is involved. So when the intermediary is not involved, an example of a procedure to comply with the standard would be to compare some of all addresses that are provided typically by the company to the auditor to physical addresses or email domains on the confirming party's website. But when the intermediary is involved, it gets a little more complicated. It's just because here's another party that should be considered. And for that, I just want, as a sort of sidebar, what the new standard requires the auditor to do when the intermediary is involved is to consider the implications, literally. Here's another party in the process. Consider the implications for using the intermediary. And it's all spelled out in a separate appendix. And basically, what the auditor is required to do is look at the controls that the intermediary has over, I guess, the most important risk to consider in the confirmation process, which is the risk of interception and alteration of information. And so as the auditor looks at these controls, some of those controls will probably have to deal with the names and addresses of the confirming party. So the auditor has to determine that the controls are designed and operate effectively. And if they don't, then what the standard tells the auditor is that the auditor should not use the intermediary and send the confirmation request himself, herself. But as we discussed a few minutes ago, sometimes the confirming party would not respond to it. And so therefore, there's another appendix in the standard, Appendix C, that when you look at it, it gives you examples of alternative procedures. If there are no questions so far, I'm going to advance to the next slide. Negative confirmation requests. So when you read what's on the slide, it just tells you that the auditor obtains generally less audit evidence when using negative confirmation requests. And as we know, the negative confirmation requests just ask the confirming party to respond only if they disagree with the information in the request. If you keep reading what's on the slide, you will see the use of negative confirmation requests alone does not provide sufficient appropriate audit evidence. So this is a change from the existing standard. Under existing standard, you can use negative confirmations and say, well, this is my response to the risk of material misstatement. There are certain conditions that are described, but generally it's allowed. Not anymore under the new standard. And the reason for that, again, if you think about what, fast forward from 92 to today, how much spam we now get on paper and electronically. There is a much higher risk now, or likelihood, that people will simply ignore that negative confirmation request. In fact, some banks, I mean your bank, my banks, they send you emails saying do not respond to a request that you do not expect. And so with that in mind, the negative confirmation requests under the new standard, they're not banned. You can still use them, please. But they should be paired up with other substantive procedures. The standard doesn't tell you which ones. There could be more than one. It's up to the auditor to decide which ones to use, but not just negative confirmation request as a sole procedure. So to help along the auditor, there are discussions of circumstances in which you can use negative confirmation, where it's appropriate to use, basically, negative confirmation requests and paired up with other procedures. I believe it's on the next slide. And they're sort of similar to what is currently in a 2310 low risk of material misstatement and sufficient appropriate audit evidence about the design and operating effectiveness of controls. So controls of working population is composed of small homogeneous items, and auditor's expectation of low exception rate in response to negative confirmation requests. And there's a basis for that expectations, maybe your prior experience with the company. That's what I have on negative confirmation requests. If there are no other questions, I'll advance to the code. This time I'm showing it to you. Okay, 668. All right, we're in the home stretch now. We're going to talk about cash and accounts receivable. So this slide shows you what is required under the new standard. So I'll read it because it's important. The auditor should perform confirmation procedures or otherwise obtain relevant and reliable audit evidence by directly accessing information maintained by a knowledgeable external source. Okay? So we're going to unpack this requirement by looking at some examples. Okay? So perform confirmation procedures or otherwise obtain relevant and reliable audit evidence by directly accessing information maintained by a knowledgeable external source. We'll take cash first. So in the new standard, cash is cash and cash equivalents held by third parties. So it could be a company's bank account, for example. So the requirement to confirm cash is new. I mean, it's typically done on audits, but it has not been required by our standards. I mean, if you think about it, cash, both cash and accounts receivable together with revenue, that's at the core of every business that makes money. And incidentally, it's also the focal point of, notorious high-profile financial reporting frauds, like we mentioned, Parmalat, Wirecard, two examples. So the higher the risk of material misstatement under our standard, the more audit evidence you need of high quality. And that's precisely what, on the previous slide, that's precisely what is required of the auditor when auditing cash and accounts receivable. Once you identified the risk of material misstatement for cash and accounts receivable, that's what you need to do. It just so happens that traditionally it has been done, that meaning obtaining that high quality audit evidence traditionally has been done through confirmation. But now with new technology, more capabilities, there are other procedures that could be done. And so so you can take a look at these examples. Well, the first one is confirmation, sort of the old style confirmation. You send confirmation requests and receive response directly from the confirming party. Email, snail mail, I cannot speak now, but paper or electronic is okay. intermediary. We already talked about the intermediary. And the third example could be when the auditor directly accesses the information on the secure website of a financial institution using credentials provided to the auditor by the financial institution. So you can choose, right? So again, the basic principle is for the auditor to get information directly from the third party, but you can choose how you do that. It's sort of, if you will, sort of future-proof in the standards. I'm not saying that in the next year, 2 years, 5 years, you're going to switch from using confirmations to using some other procedure, but at least you know that the PCAOB standards do not box you into sort of the old-style confirmations. You know the basic principle, and you follow that principle, and there could be other procedures that provide same or even higher quality of evidence. Now, if you chose to use either old-style confirmation, new-style confirmation, directly accessing the materials, information from the third party, but for some reason you could not get that information. So there's the confirming party did not respond to the first request, did not respond to the second request, ignoring you. What do? You perform alternative procedures. I already mentioned they're in Appendix C, and there are several per financial statement item, cash, accounts receivable. So you can go to Appendix C and see examples of alternative procedures. It's not a checklist, they're examples, but they're useful in the sense they can orient you in what kind of alternative procedures you do. So for cash on this slide, you can see that an example would be you verify cash balances by viewing the information directly on the secure website of financial institutions. But in this case, for that item for which you did not hear from the confirming party, the credentials could be provided to you by the company, and the company personnel can access that information on the website. But the auditor still has to, in this example, verify the validity of the website. That would be looking at a security certificate for the website, verifying the domain name, etc. Okay. The very last item on the agenda is accounts receivable. A little different from cash in the sense that if you think about accounts receivable, unlike with cash, there could be examples where obtaining that external information directly, it's not that it's impossible, but it's not feasible. And what I mean by that, if you think about industries where historically you saw very, very low response rates, things like healthcare, things like utilities. So it's not impossible, like there are actual people there are companies, but you can send your confirmation requests, but chances are you will probably not hear from them. So the standard recognizes that. That's another sort of new thing that's in the standard. You document your determination that it's not feasible, and it gives you some hints how you do that. So it could be based on your prior experience, etc., where you expect the similar results. And in this case, you can obtain the information indirectly, external information indirectly, by performing other substantive procedures. And here I would emphasize using the test of details. So performing substantive analytical procedures would not be compliant with the standard. These are examples of alternative procedures, and even though they're described as obtaining external information indirectly, those are the procedures you have been performing for a long time. What's external information? It's not the information produced by the company. So a flat file received from the bank, that's external information. It's in company's possession, but it can be traced to the financial institution. But you go to the company to get that file, and so you're obtaining that information, but you're obtaining it indirectly from the company. And so the examples here are subsequent cash receipts, shipping documents from third-party carriers, and customer purchase orders or signed contracts. Okay. One last thing to mention, under existing PCAOB standards, as you know, the auditor is required to discuss with the audit committee the significant risks identified during the auditor's risk assessment procedures. And so under the new standards for significant risk guarantee statement associated with cash and accounts receivable, new standard requires the auditor to communicate with the audit committee when the auditor did not perform confirmation procedures or otherwise obtain audit evidence by directly accessing information maintained by a knowledgeable third party. If you think back to that very first slide on cash and accounts receivable, that requirement, if that was not done, the auditor would have to tell the audit committee for significant risks. This concludes my prepared remarks. If we don't have any time for questions now, I will be here all day flying back tomorrow, so you can talk to me anytime after this. Thank you.